I think with such a strong majority and a strong win, probably gives government a real chance to sort of almost portray themselves as the legitimate leaders of a country. I would think that so long as people get the rate cuts which they're hoping for, so these are people with mortgages, I think confidence will pick up.
On this episode of the Success Times Happiness podcast, we welcome Chris Harris, an economist, radio commentator, and a sharp-witted analyst with a passion for helping Australians understand their money. Just days after a sweeping federal election result, Chris unpacks the real implications for our economy, housing market, and personal finances. From tax reform to investment strategies, he brings clarity, insight, and just the right dose of humour. Whether you're a seasoned investor or just want to stretch your dollar further, this conversation will sharpen your thinking. Let's get into it. Chris Harris, welcome to the show.
Thank you, Richard. Thank you very much for the invitation. It was very unexpected, but I really appreciate the invitation, so thank you so much.
You are a boffin when it comes to all things financial markets, economics. You're on the radio every morning delivering dulcet tones and intellectual concepts to the greater community who listen to the ABC. But what is your favourite episode of the podcast that we've done so far?
Well, that's a very good question, Richard. I've never listened to your podcast, and I said to you that I would be upfront, and I said to you that I would be honest. So it was interesting because for today's podcast that you and I are doing, I thought, I wonder what Richard has done in the past. So I got onto LinkedIn and had a look. And by the way, you've had some very interesting topics. And following this, I will go through and I will go and listen. Part of the reason I decided not to listen in the end was I thought I don't want to have any preconceived ideas what this will look like, where we go.
I think I used that example when I didn't do homework at school. Like I didn't want to have any preconceived ideas going into this exam.
Yes, exactly.
You know, I wanted to have a fresh mind.
Fresh mind. Let's see where this rolls.
You are the thought leader though, so I really appreciate your time. Now, we're releasing this only a few days after the 2025 federal election result. And so we are skewing this chat more so about what it means for the country, what it means for the listeners, and your take on it generally. So to start off with, financial market perspective, what has the weekend done anything to it?
Funnily enough, no, not really. It is interesting in that I think sometimes when there's indecision, it can actually be worse for markets because there's going to be horse trading and what does each party want and what is each candidate looking for out of this sort of hung position. But what we have seen is Labor's just had a thumping win. Now, whether that's a thumping win because their policies were excellent or whether the Liberal Party was just abysmal, I dare say it's a little bit of both. To answer your question, though, there are always implications, always. And the secret with looking at where to next or how will this play out, I think you've got to look a little bit to what the announcements were around the election, but then you've got to follow that on with will they be able to or how will they be able to implement these? So if we have a quick look at, let's say, some of the guiding statements. One, this is going to be a big spending government. It will continue. We have budget deficits for quite some way to come. Now, our sort of debt position as a country is not too bad in a global context. But we are about to spend more than what we raise via taxes. And so you would think that economic activity would still look pretty good here. Now, you might say, well, what's the implications of that? Well, maybe, just maybe, we find the RBA is less in a position to be able to cut rates and maybe people are looking more for a rate cut than they are for more stimulus in their life. They're the sorts of things that I think are probably forthcoming and maybe some things that might sort of come down the track.
And we're trying to be bipartisan here in
course.
terms of we're not necessarily putting our own political views ahead. What do you think the result itself will do to investor confidence or to at least maybe even consumer confidence with this, I guess, not necessarily with the Labor win, but I guess with a win that is so overwhelmingly one-sided? Yeah,
look, I would think that so long as people get the rate cuts which they're hoping for, so these are people with mortgages, I think confidence will pick up. I think with also such a strong majority and a strong win, probably gives government a real chance to sort of almost portray themselves as the legitimate leaders of a country. So that's probably going to work out pretty well when you're dealing with guys like DT, Donald Trump, and Xi, from China, it does give you a nice standing in the country that you have been backed 100%. So I think from that point of view, there could be a little bit of pickup in confidence. The other things we've got to remember is that they are a spending government. So things that they want to look at and ensure that, aspirational people are getting a bit of a go. We know that there's policy around housing. They'll continue to spend money on infrastructure. They're right into healthcare, education, and those sorts of things. So look, there's some policies there that I think could just lean a little bit towards that, a nice confidence in the general consumer. The biggest issues we have are really twofold. The first one is we are still unbelievably heavily taxed, for hours worked.
We talked about this last week.
Yeah.
Yeah.
Okay.
Well, let's get into this.
Yeah.
This is the Chris Harris, the third iteration of the federal tax legislation.
Yes.
And I know that this is, look, and I know you haven't listened to the podcast.
No.
Okay. So you don't know the guests, you don't know the topics.
No.
We don't I don't think ever we've got into law.
Whoa.
Or have we got into finance?
Holy.
In this level, right?
Whoa.
So strap on in.
I was going to say.
Because this is unfortunately my jam and my bread and butter. Talk to me. Why is it? What's broken in this system with the marginal tax rate system?
Yeah.
As you see it.
Yeah, as I said. So before I answer that, what I am curious to know is what are the lowest listener numbers you've ever had? And I think we have a chance of dropping below that.
And you don't have to say anything. You can just blink twice if you want.
Yes.
But does the ABC hold you back from these sort of discussions on air?
No. I mean, the ABC have been really good to me, actually. I've always tried not to overstep, obviously, because you do have to make sure that you're not advertising, et cetera, et cetera. But they're a good crew. They're a good crew. Seen them face to face a few times, so it's been good.
You can't advertise or admit it or
correct.
Right.
Yeah. Oh well, no, they'll announce this, but you can't really say, oh, this is specifically what I think, and
this is the new product.
This is is our new service that we're introducing. You wouldn't believe it; it's the best. That sort of stuff
solves the problem that I've just created.
Exactly right. This is gonna sort of change your life. You can't say that sort of stuff. So
all right. So marginal income tax brackets.
Yeah. So something that's been observed for a long period of time now is that governments rely way too much on salary and wages to collect tax, really. I mean, there's other ways of collecting tax. It's through corporate. It's through maybe taxing profits on mining, profits on minerals, profits on resources, increasing the GST, making sure that large offshore let's call it companies are paying their fair share. I think I saw a news headline today that I think something along the lines of 1.3 billion revenue for Netflix, but no tax. I mean, you have those sorts of things. So what we're relying upon is we're relying on the donkeys, you and I, to work harder. But the problem is the way the Tax Act currently works from a personal point of view is the harder you work, the more you earn in theory, the more tax you pay. So it's a real disincentive to actually having people sort of focus on that sort of harder, probably necessary work to raise revenue because it is just so expensive. Whereas on the other hand, and I wouldn't be surprised if the Labor government looks at this, whereas at the moment capital gains tax is very favourably treated. And let me give you an example. If you were earning, I'm going to say $300,000 per annum, you make an extra $100,000 through salary and wages. Let's just say you're going to lose 50% of that based on marginal tax rates. If you made $100,000 profit on a property sale, though, and you've held that asset for greater than 12 months, well, they ignore the first 50%. So only $50,000 is subject to tax at your marginal rate, which works out to be about 24.24% or 24.25%. Yeah. So the bottom line is that there is this mismatch in our system at the moment.
So they're essentially you're paying full rate, inverted commas, of tax based on your personal exertion. But,
well said.
But you're paying half of that rate on assets that don't actually stimulate the economy.
Yeah, and that's a great observation. So people would say once you've built a house, that's it. That's the productive part of the economy. And so don't be surprised if we do see a few little changes to, I think, policy, but I don't know. I don't know, mate. I don't know. I would like to see tax change a little bit. I think GST should probably go slightly higher and maybe a little broader.
Hey,
I know.
whoa.
So you get consumption.
We
so
will
it's
cut
all
that
on
out.
consumption.
We
Yeah,
will cut that out.
cut that
Let's
out.
not give anyone an idea
No.
of a New Zealand style
I know.
GST.
Yeah, I know. But it does say that if you want to consume more, you pay a bit more.
Yeah.
That seems reasonable.
Just don't buy stuff.
Make it yourself.
Let's look into the specifics of what you understand as what we all just elected in terms of economic policy.
Yes.
Where do you see it?
Yeah, well, really what we're looking for, or what governments have sort of said they'll put forward is there's a lot of assistance being provided. It's all, this is, helping people. I suppose I'd put it another way. They are trying to have less impediments to certain things. So they do want you to go to the doctor more, so they'll increase the bulk billing. They do want people to engage in education more, so they'll put more money into education. So there's a few things here that I think are really, really useful for society, for sure. As I said, though, the issue that we have is there is a lot of spending in this budget. Whether or not it's productive in nature or not will be seen. We do need to increase productivity, which just means we get more bang for our buck. That at some point does have to pivot. But maybe with such a majority as they've picked up on this occasion, they can actually afford to maybe have 1 or 2 years of where things are just a little on the lazy side, and then sort of push harder into the next election. And if they come, I think whether it's Labor or whether it's Liberal, whoever I believe comes to the economy, or let's call it the constituents with the best policies, I think may end up winning the next election. I mean, the Liberal Party is so far gone. Come up with something decent, push hard on it, really look for change. You got to do any worse? Probably not. And then on Labor's side, if they're brave enough, then I would push hard on the majority that I've got, and I'd say we're really here to change. So I would think over the next couple of years, basically just expect, 1, governments are going to spend more. 2, I don't know how much they're going to focus on where it's being spent. So 3, we're going to, as a country, borrow a lot more and probably get very little for it.
It's a positive outlook for you.
Well, it just means money in the system, doesn't it? And that's the thing. Money in the system is one of those, that fiscal policy side of things. Obviously is on the other side, you have monetary policy. But if you have too much on the fiscal side, don't ask the RBA to start cutting rates. The RBA will sort of dance in the shadows or dance alongside the fiscal policy. And the more you push in, then I think you'll find that the less they are likely to cut.
With inflation getting underneath that magic figure, do you think the election itself impacts, and I guess the result and how one-sided it was, do you think that'll impact the RBA's decision next week?
Yeah, look, I don't think so, but policy, the RBA's got a challenge on its hands at the moment, doesn't it? It's dealing with a confluence of forces, whether it's out of the US, whether it's out of China, or then whether it's even just domestically. Some people would suggest that in times like this, you're best off just keeping your hands in your pockets. I would prefer that they cut rates by 25 basis points, because that's basically what the market's expecting and what bond markets are pricing in. And I think that if you meet market expectations on this occasion, people, that confidence that you were talking about before, I think that sort of makes its way back through into the consumer, which I think is really important. So I would think the RBA is really, between a rock and a hard place. It really is. But Michelle Bullock's really good. If you ever listen to her, she's fantastic. You're right, inflation did come back into the band, but you can't forget that part of the reason it came back into the band was because the Labor government did bring in a subsidy around electricity, which then obviously produces that sort of part of it. So what you do want to see, though, is energy policy here in particular. If you can get that under control, then that sort of takes a bit of pressure off. But yeah, watch this space. That's a really good question.
Do the fund managers that you deal with and the products and the people behind that, what are they talking? How are they talking in the whispers with respect to the election and before and after?
That's actually a good question. I haven't spoken to any fund
You
managers
sound surprised, Chris.
Well, every so often, Richard, you do impress me, and when you do, you really do, as you just did. It's interesting. I haven't spoken to any fund managers post the election, but I know that Mal Wood, who works within Ords, put forward his views, and obviously he sees this as being a stimulatory sort of next few years, and this is where you get this sort of rub up against monetary policy with this fiscal policy push. So. I would think at this time, fund managers, let's call them equity managers, are probably looking more, I would think, from bottom up. So they'll be looking for equities in particular that they think could do well out of this. So to give you an idea, if we start to see more money come into health and the like, well, then you'd have to think someone like Sonic Healthcare does okay. And then you've got all of these sort of diagnostic companies that should do okay because money's going to come back into the system, which means people go to the doctor. One of the first things they seem to say now is go get a blood test. So pathologies looks pretty reasonable there. So you'll find that on the back of this sort of thumping majority, you'll find that fund managers are looking under the hood at businesses and what are their sort of push and pull levers. And they'll end up just picking the eyes out of a few of those names. You'd have to think, consumer staples look pretty good. That's like Coles and Woolworths and Metcash and those sorts of things. If we can get things right with China in terms of our policy settings, well, maybe BHP and Rio start to look good again. They're trading on a pretty reasonable PE. What is interesting though is depending on what happens around interest rates and then what happens with banking, maybe the banks just don't seem to outperform for the next little while. Westpac had its result the other day, and that was a bit on the underwhelming side, really. But it's showing there's lots of competition out there at the moment amongst banks, which is good. I mean, as a consumer, you want that.
And going forward, what are the risks, do you think, in terms of the election result? And yes, a lot of spending, no doubt, as it always would be the case, but maybe a little bit more or a bit more liberal with it based on the majority and the value, how much that swing was. But what are the biggest risks to the economy itself?
Well, I don't think you're going to get an overheating, but you definitely don't want an overheating either, because that's the case, then you're going to see rate rises. Now, no one wants theirs. Well, no one's pricing them in at least. So you start to see, some heat come back into the economy and inflation doesn't start to sort of stay within that band.
Is that because they're just pumping too much in?
Well, yeah, it can come back to that. It can come back to that because what you end up with is money in the system. And so the more money in the system, you then have, in theory, more cash running for the same number of assets. But you may be able to argue that where they're putting some of the funding, let's call it into health, maybe that's not too stimulatory. Into education, well, that could also be the same, not too stimulatory. We do need more housing, so in that regard, money going there is important. But again, if you don't look at immigration and all of a sudden you have more people fighting for those assets, you don't actually improve the problem of the housing shortage. You end up in a scenario where you have the same number of houses being built equal to the people coming in. So you don't actually solve that problem.
I saw a graph recently about the cost of housing relative to the average household take-home pay.
Yes.
Over, must have been from the 70s.
It'll be decades, yeah.
And it's exorbitant.
It's unbelievable.
It's unbelievable.
It is.
And I don't know whether I'm misquoting this, but I think it's like, do you know what factor that would be?
Yes.
What factor would that be now?
8 times.
8 times. Average take-home pay for the household.
Works. Correct. And so back, many, many years ago, when you and I were little boys, I would suggest, it was basically 3 times.
Yeah.
So to go from 3 to 8 times just is such a burden. And this is where it comes back to this policy setting before, as I was saying to you, around marginal tax rates and the way they sort of work. You end up in a scenario where you're working harder. Let's say you get into the top marginal tax bracket, which is a good achievement. you're giving away then basically 50% of everything you earn above that point. You've then got GST on anything you buy anyway. But in addition to that, you then got a mortgage, let's say, and then you're using that small amount of money after tax, after GST, to actually pay the asset off. I mean, it's bloody hard work. They're the people we've got to look after. That's where I think the tax policy, as I said earlier, it just needs a real looking over. And there needs to be a considered change across many, many taxes. And if you blend it right, you'll end up, getting some real incentives and some real productivity. But yeah, to your point, it's really expensive. To get a house now is expensive. You don't need rates at 17%, do you?
No.
I mean, honestly, you borrow $1 million and your interest rate's 6.5%. That's $65,000 a year. That's after tax.
That's gone.
That is tough going. That is really tough going. And we need to do something about it. It's just not right.
And you then give that post-tax money to the bank or to your borrower, to the lender, who then needs to declare it to then get clipped again.
Yes, again. Brilliant.
It's a great system.
That's right. How much did Netflix pay in tax again? 0. That's right.
It's just a tough year, Chris. It's a tough year.
Some good shows. But we're not paying tax on those.
Is that number, that 8 times, do we just have to, best case scenario is to slow that, or could we reverse that?
Well, no one wants a reversal, do they?
No one wants the price to drop.
No, exactly right.
So the other factor would be the income.
Well, yeah.
You increase that too much, then that puts pressure on inflation.
Look, yeah, it definitely can, for sure. But as I said, if you get your policy settings right, so change marginal tax rates, maybe remove a bracket or two, have a change in the GST, overlay that with some stamp duty, maybe land tax, a few things like this. If you change things meaningfully, I think you'll find that, look, it'll allow people to have more disposable income to be able to afford some of the basics, and housing's a basic. Or I think what other people do these days, from what I can gather, is rather than going for your principal place of residence, you stay with mum and dad and you go and buy a rental property. And then the advantage to that is you get all the interest expense to offset against your taxable income.
Yeah, and you can buy it in any entity's name as well.
That's right.
Your own. If I'm a retail investor, if I'm wanting to invest, I think I said to you, let's say we had $50,000 in the bank sitting
Let's
there.
up it, Richard. This is you.
Nah.
Big dog. Let's go. Come on.
All right. Well, let's say 100
Now you're talking.
in the bank,
Uh-huh.
sitting there at 5% because you got that from the bank.
Mhm.
Which effectively is net 2 with inflation.
Mm.
What would Chris Harris be suggesting? Now, you're not giving any financial advice.
Can't.
If you want, speak
Don't
to him.
know you.
Chris Harris.
Never met you.
Ord Minute. Give him a look up.
Yep.
But what would be the avatar?
Well, I thought about this is the one question which we did discuss. I think it was yesterday, and I did actually consider 2 answers, and the one answer is really boring.
Investing in a podcast.
Yeah, well, is this really an investment? Doesn't look like it.
It's a good haven.
Yeah, this is an investment. I don't want it. No, I'm happy to be a guest. I'll be back.
You haven't listened.
No, I'll be coming back. You know that. So in terms of there's two answers. The first one is, if you wanted to.
Let's say you're young. Let's say you got that time when you're young.
Yeah,
so
well, that's right.
Let's go 50 grand, mid-20s.
Right. Okay.
You've saved up.
Yeah. Well, as I said,
It's hard to get into the housing market.
I know. Well, look, there's solutions out there these days that are really simple. So you just sort of decide, what's my risk profile? And you're in your 20s, you'd say, well, look, my risk profile is probably higher than someone in their 80s. Have to be.
Sure.
Therefore, I would go with sort of a high growth setting, which would say
you'd go stocks.
Well, you'd go 95% of your money invested in assets, whether it's Australian equities, international equities, property, and you'd have 5% in cash and fixed interest. That's because you're happy to ride that out and you want to see the compound growth. Now, there's a couple of solutions out there. You can literally buy a single investment, a single line item. They'll give you that exposure straight away. So they're generally via ETFs, exchange-traded funds, really easy to do. And I did think about that answer, but that to me is boring. Boring. What I did think about, though, is what would I do with that $50,000? And if I had to sort of and again, to reiterate what you were saying before, Richard, this is obviously not advice. But if I was to look at settings in the world at the moment and areas that I think look okay, I would think if you're going to invest offshore, you can still buy a domestic Aussie company, but you want it to have earnings in the US. And something that comes to mind is, for example, BlueScope. So they actually produce steel in the US. I think that's a really interesting name. Good balance sheet, so it would be something that you could easily sort of pick up and be happy with. If you then wanted to say, well, if we do start to see wages pressure and the like, and the cost of capital does start to rise in this country, then you want capital light businesses. So think of things like Generation Life, which sells annuities, insurance bonds. Think of Challenger, does the same sort of things. Both pay a reasonable income, so you'd be happy with that, better than the bank. If you then said to me, okay, Chris, well, let's say there is now a little bit of a push towards development and property and the like. Well, then in that regard, I think you'd look at something like a Peat Group, PPC, basically owns land across the country and develops it and then sells it off. So that's a pretty interesting business to look at. But then you could also look at something as boring as a Centre Group. Now that SCG is basically Westfield, Australia and New Zealand. But what people underestimate about this name is that they are slowly but surely changing that retail landscape. So you go there now, it becomes a bit more of a destination. And the other thing which they are capable of doing is potentially turning it into a bit of resi as well. So whether that's units on top or around it, those would be the sorts of things I would look at. If you really wanted to sort of get down to the nitty gritty of it, rather than sort of choosing a single line item like a Vanguard high growth option or something along those lines. If you wanted to sort of have a look at a few things, that's the world that I would sort of look at too. So I've two flavors there.
Hey guys, just popping in with a gentle reminder. If you're enjoying this episode, we'd love it if you'd give it a like, hit subscribe, and leave a comment with your thoughts. It's free and it really helps us grow and continue to share these stories that matter. Cheers. When you got a client who comes to you and is like, I like property, probably because I don't like how binary the green or the black or the green and the red is when I see it on my phone. Every single day I've either won 1% or lost 1% and it drives me crazy because I'm checking this every half an hour.
People do.
And it's so easy to come in and out.
Easy.
Versus a house where it's like, I'm loaded to the max, but I can't move it.
No.
And I have to wait for 10 years before I know that it's
exactly
doubled in value.
Yep.
Is it the client's relationship with money, with value, with an investment? How is it? And part of me as well, like you sort of go, well, historically, because after the bottom, the small bloody finger, like the fine print of everything you produce, everything in your industry.
Yes.
So
it's small print.
History.
It is.
Historic data is not a representation of what's going to happen.
No. And it's normally a 4 font. Like maybe 5. Beyond 5 and someone's...
I didn't even know that went so low in Word.
Someone in marketing has messed it up. I mean, if it goes beyond 5, something's wrong.
Cheryl, it's 14. It's meant to be 4. Fuck.
That's right.
But how is it just this position of it will definitely like this blind faith in the economy, in the share, because you sort of go, well, you're trying to beat, you're trying to be outperforming the market, inverted commas, but unless you're going to go all in on one stock and full risk, you're only going to be outperforming on average 1 or 2%, which I appreciate is a lot given over time and given a lot of start. But how is it that people can just go, it's dropped by 10% or 8%. Not enough to double down and buy heaps, but just to go dollar cost average and go, just keep going. It'll be fine.
Yes. Look, it's a really good question. And what I've tended to find over time and through experience is that it really does come back to how people view money. So if you have...
This is much more interesting for me. This is more closer to the podcast guests rather than the election chat. So let's go into this.
Okay. So what I tend to see is that some people will look at each line item very closely. If we build a portfolio bespoke, all Australian shares and a few ETFs through it, and it'll be the one loss or the one stock that may be down for a period of time that is the one that just grabs all their attention. what I've tended to find is that the way that I've dealt with that sort of very, very close looking at the weeds is you have to almost take a big step back and step away from the magnifying glass and actually stand back and look at the total portfolio and the total position. So you can't look at a single line item that might be down $5,000 where the portfolio might be up 100,000.
Mm.
So you need to give them perspective. Perspective's the real key. And it's once they get perspective, you can say, well, you're up $100,000. Yes, we're down 5 on that. Do we still like the business, yes or no? If we don't, then there's a decision to be made. But if we still like the business and it's just the share price has fallen, then just hold it.
Mm.
And that's the idea behind, let's call it portfolio building. If you have one of those names that is possible for it to drop by 50% and in quick time, then it's not a big part of your portfolio.
Mm. It can't be.
No, it can't be. But it comes down to, again, people's risk tolerance. Like there's been times in the past that I've sort of had a swing at a few things because I think, well, this is a really good business. It's mispriced, and I think it can go well from here. I got some right. I got some wrong.
What is your take on risk tolerance? Part of me thinks everyone's is relatively similar, but the education around that decision is what's the difference, is the differentiating factor.
Yeah, I think you're right. I look, everyone likes making money. No one likes losing money. I mean, that is universal. So that's your baseline. So then it's a matter of how much you're willing to sort of put to risk at any one point in time. And I think most people are really around balanced investors. So they'll always say, well, I'm happy to have a lot of my chips on the table, but I want a few of my chips just kept to the side here. And that's effectively how it works. But I think you're right. I think most people are really similar. So it's just when people become more comfortable with how markets function.
That's an information.
Yeah, that's information. That's time.
People go, I don't know. That's too risky for me.
Yes.
And it's like, well, if you knew everything that I knew, we'd be on the same. It'd be a parity position because it's just that you haven't invested your time into understanding it to its fullest degree.
Correct. And you can always get hit off kilter. I mean, you just need Trump to sort of do what he said the other day, and all of a sudden markets fall heavily, like really heavily within a quick period of time. They've sort of rallied amazingly back since. 9 out of 10 days have just been phenomenal. You'd probably think that at this point, if you've just held, you're actually doing okay. You're actually doing okay.
But isn't that's the theory of all, right?
Yes.
And any asset. Well,
it is. People do espouse the view that time in the market is the be all and end all, but I still do believe timing the market's important.
Okay.
I think the two work well together.
Talk to me then. So if you had the 50 and you had your schedule and you're like, all right, I'm going to, and not to turn the 50 into 100 quickly, but just say I want to properly invest this in for the future.
Yep.
Are we going hard now with the 50 with the idea that, let's say, we're going to put in a couple of grand every month or something and dollar cost from then on? Or do you hold off on that lump sum dollar cost, 10 a month?
Yes. Okay. So
what's the strategy?
Yeah, with that 50, I would actually blend both answers I gave it to you earlier. I would allow 25 of that to straight away be into some sort of index or sort of ETF position. And that you can afford to dollar cost average in. So you might say,
over how long?
I'd probably say 5 months.
Okay.
So
5 a month.
5 a month for 5 months. And that'll help you sort of push through, this sort of shorter term volatility. Then with the remaining 25, you would narrow that down, I think, to no more than 5 stocks.
Okay.
And then with that 5, then you can actually just choose the stocks depending on where their price points are. I'll give you an example. The reason I mentioned some of those property trusts before is that they're due to pay a dividend at the end of June. And so you can easily pick up a dividend now for a 6-week hold. And so you would just cherry pick those ideas. And you can afford to be patient with 1 or 2 of them potentially because they won't pay a dividend until August. But that's how I'd go about it. You've got to get the process underway.
Then is it with your whole position of how people's relationship is with money, is it become a habitual thing to go, okay, we're just going to almost try to forget, leave it to the experts, but try to forget that's what we do,
Yes.
and you just punch the money in, transfer the money into your strategy, and try not to open the apps and to see how it's
But
performing.
how good's to look at an app? I love an app.
And to not be so, don't write it every single day.
Yes. Well, that's the important bit.
I struggle with the control bit.
Yes.
But that's now outside of the performance of that
Mm.
is out of my control.
Yes, it is. Yes, it is.
And I struggle with that as a concept.
Well, and you know, so do I to some extent. But then at the same time, if your position is not just a single position, but it's a series of positions, then each position you can judge on its own merits. And there are times where you've just got to get out of stuff. You know, management's done something stupid. Something's happened to that business in a way that has affected it. It will not improve. Then get out. And you just have to. So you can't fall asleep at the wheel, that's for sure. But at the same time, if you find a good business, stick with it.
Okay.
Stick with it.
All right, another question before I'll let you go. Same person has $50,000 sitting in the bank. That person now has a home loan with an available offset. So it's 6% interest. You've got $50,000 basically earning 6% tax-free in the offset. So therefore, if they're on, let's say they're done well in their 20s and they're on top rate.
That's your listeners. That is your listeners.
I'm not surprised.
Yep.
Then where is that? What's your advice? Do you say
keep it in the offset?
Keep it in the offset.
Yeah.
Until you what? A mortgage free?
Well, it depends on the
what does
rate
the math,
of interest.
What does the math work out to be? 12 or 14%?
That's right.
14% you need to get from your stock.
Correct.
To be equal to the money sitting in your offset account in your bank.
Exactly right. Even if you said 12%, you made it even just a lower target. But yeah, you're right. And that's the number.
And the ASX 200 or a EFT of that level, what's the average there?
Well, it's not that.
It's not that.
No,
Let's call it that.
No, it's not that. It's not that. And,
so
we've had some cracking years. So you would expect that there will become periods in time where you might get 1 or 2% or even minus numbers.
So with every single person who has a mortgage and an available offset, why would you, other than you're already in the market, you don't want to trigger any CGT issues, why wouldn't everyone just be banking it into the offset?
Well, you would.
Right.
And that's what you should be doing.
Okay.
And so really what...
Again, no advice.
No, exactly. Well
The full font.
Is this conversation even happening?
The four size font that Cheryl's finally got sorted.
Here? What happened?
We're not giving advice.
No, we're not. What I've tended to see over time, if you want to look at just structures really quickly, I can understand the attractiveness of your principal place of residence because it doesn't have capital gains tax upon sale. And then so that's that investment. That's not so much a structure, that's just an investment. On the structuring side of things, the best structure we have, funnily enough, is actually superannuation. And the reason it's the best structure is because its taxed income is taxed at 15% and some capital gains as low as 10%. And then when you get old enough, you and I aren't there yet, but I look older than you. So let's call it 65, let's just say. Then you can start a pension. You pay no income tax and no capital gains tax. So that's the best structure. But then I can understand why people focus on the principal place of residence because that is also a zero tax environment. That's the two sort of pieces.
And you're probably going to move that asset at some point during your life before you're 65.
I would think so.
Yeah,
I would think so. So to answer your question before around what do you do, well, you do the best you can to get rid of that mortgage as quickly as possible. I know there's some strategies out there that would say buy a few rental properties and then use the income from those to help reduce the mortgage. Not a bad idea. But you've got to understand you are taking on leverage to get that outcome.
And whether that's legal as
well said. You know, so that's why this is just a conversation.
This is just a conversation.
This is a chat. So there's all sorts of things that are sort of out and about. But really what you want to do is once your house is paid off, if you ever use that then as your, let's call it your equity for the next position that you take, you draw against that as an example, and you use that for a tax-deductible purpose. That's the goal, tax-deductible purpose. You do that, and then you can keep building from there.
Mm.
But it's tough. I mean, back to our earlier point. I mean, it's just bloody tough. I mean, the size of the mortgage you've got to take on to get into housing to then pay it off, it's a challenge.
Hey guys, before we keep going, a quick reminder, if something in today's chat has landed with you, please like the episode, subscribe to the show, and share your thoughts in the comments. It helps us more than you know, and it means we can keep inviting voices that inspire. All right, let's get back into it. And then finally, with the government and this whole, speaking of super, well, do you see this Labor's position on, I think it's what?
Division 296? Yeah. No, I think sadly that'll probably come in.
So
and
that's,
it shouldn't.
These are my listeners.
Yes.
The superannuations with,
yes.
with above 3 million.
Yes, now you're talking. The barbells.
Talk to me about it.
Well, it's an interesting concept. What they're basically, superannuation is the best vehicle we have.
Like you said.
Yeah. And so when you consider that income's taxed at 15%, some capital gains as low as 10%, and you get to pension mode and it's 0. Years ago, it was you could almost put any amount of money you wanted into super. So you could end up with a very, very large super fund paying very, very little tax, if no tax. In fact, you'd probably get a significant franking credit refund. So the governments have recognised that is just a tax black hole. And it is for them. I mean, they literally collect nothing. In fact, they're writing checks to people, so they're probably a bit sick of it. So then they're trying to work on, well, we need to incentivise people to actually want to grow their super. And that's why we have a thing called now the total super balance, and that goes to $2 million from the 1st of July. So that's the amount of money you can put into super, let's say. And then the amount of money that you can convert from being an accumulation phase to pension phase is the transfer balance cap. And funnily enough, that's $2 million too. So what they're basically saying is look, there's a limit to how much we are happy for you to have in a zero tax environment. The number they've chosen at the moment is 3 million. They're saying, well, if you've got more than 3 million, that's an individual, so it's a couple, it's 6 million, then we think there should be some tax payable, some extra tax payable on earnings on those funds above 3 million. The problem is that one of the concepts is that they are looking to tax unrealised gains, not income. Unrealised gains.
Of the assets.
Of the assets. That's just not good policy. That is, I cannot see how that's sensible in any way. And I just think that I'd prefer, so maybe a simpler concept, and listeners here might just about spit out their cup of tea, but rather than just saying, well, we're going to pay 30% above 3 million, why don't you just make tax payable on all super assets of 15%, whether they're in pension mode or not. It's a simpler change. It's an idea. I have some every so often, but it would be simple. I mean, it'd be much simpler because this idea of taxing an unrealised capital gain is ridiculous. I think you'd agree as well. I mean, imagine if they did that to your rental property.
Yeah, and then
outside of super. They say, oh, geez, Richard, you had a good year last year. You've been able to convert, this 5-acre block into a subdivision. Oh, congratulations.
Here's a bill.
Here's a bill. I haven't even sold anything yet.
Yeah, haven't moved.
Haven't even moved.
Just owned it.
I just owned it.
Yeah.
So that's
not ideal.
Now, can I ask, how long do these chats go for generally?
We're only just in the introduction at this moment, so we'll get into this chat shortly.
Really?
Yeah. So thank you.
I'm exhausted.
No, actually, we haven't. Just realised we haven't pressed record, so I'll have to. Chris Harris, welcome to the show.
You're kidding me. I'm out. I'll just drop the headset. Are you being serious?
Before you go,
yes.
5 questions, quick fire.
Oh, whoa.
I haven't even prepped you. I talked to you about yesterday, but haven't prepped you these.
Okay.
All right.
Yes.
So thank you for your time. As fast as you can come back to me. Right.
Yes.
What does success mean to you?
Being able to make decisions in your life. Good.
What does happiness mean to you?
Sitting on my ride-on mower, looking up and watching my daughter and wife sort of mucking around with their horses, having a bit of fun. I'm happy with that. Or seeing my son and other daughter. That's happiness. I really love the family.
Cute. What's your morning routine look like?
Up around...
What time?
Let's call it 5:30, 6 o'clock. Watch the US close, prepare for the ABC business report for about 7:40. Write that, prepare that, go from there.
Get into it after that.
And every so often what I have done now is after I've done the report, I then head up to Parklands and try and do a run.
Oh, do you?
Yeah. But I run into the Emu. I hate that emu.
Yes. Do you go Atkinson Road or do you go the main entrance?
I go the main entrance.
Okay, the emu is down there too.
I hate that.
Oh, yeah.
Have you ever seen the emu?
For the listeners, there's a state park near us.
Horrific.
And there is a semi-wild, I think it's actually a pet, but
it's a pet.
But
did you say pest?
It's very friendly.
A pest in my life.
Very friendly emu.
He knows me.
Yeah. What's his name again? Like Bubbles or something?
No, I think it's is it Eddie?
Is it? No,
Fluffy.
Fluffy. That's
Fluffy.
what it is.
Yeah, okay.
Yeah.
Yeah.
There was another one. There's two more questions. And I can't think of the fourth one. Oh, I know. Yep. A piece of advice that you'd give to your younger self, or like you put on a billboard, I guess. What would be the advice that you would give to the world?
Keep going.
That's good. And then finally, a guest you think we should have on the show.
Ooh.
That would be a good listen. Famous, connected, or otherwise, doesn't matter.
I would say Tony Kelly.
He's been on the show.
Has
you
he?
Dickhead.
See, I told you I haven't listened to anyone here. But he would be fantastic.
Tony Kelly has sat in this chair.
Oh, really?
Mm-hmm.
Was he really good? Did he get a lot of listeners?
His was very good.
Yeah, he would have got a lot of listeners
very,
too.
very good.
Yeah, I know. Unlike this episode. This episode is going to be our lowest ranking. Who else could we see? Maybe go with Jocelyn Walker.
Talk to me about Jocelyn.
Been on the coast for many, many, many years. Her husband and herself started a thing called Moby Vix, which is as you're travelling down the coast, from the coast down to Brisbane, where you get that Beefy's pies and the other things. Yeah. So that they started all of that.
Okay. At Wild Horse.
Near Wild Horse, that's them. Yeah. So she's really interesting, and she's like unbelievably well connected. Very generous with her time. She was involved with the university with me. Is heavily involved with Life Flight. Heavily involved with Sunny Kids. Yeah, I find her a really sort of cool person to talk to.
Perfect. Perfect thought. Chris Harris, thank you so much, mate. It has been a dream.
Oh,
Appreciate
Richard, thank you so much.
Till next time.
Till next time.
All right, mate. Cheers. That was another episode of the Success Times Happiness podcast. Next time you're trying to figure out your taxes, turn to the person next to you and tell them all about the show. It really means a lot. A big thank you to Chris for his time, clarity, and wit. What a conversation. If you enjoyed this episode, please take a moment to like, comment, and rate the podcast. It really helps us grow and reach more curious minds like yours. Until next time, peace.